So let's take the discussion forward with Nimesh Chandan, who is joining us now from Bajaj AMC, which is the arm of Bajaj Finserv. Nimesh, thank you so much for your time. Good to see you in your new role as well. You are making an observation that this year onwards, or this phase of the market, should be approached at differently versus how last 2-3 years has been. What is the change of stance, and what merit on the back of which you think that the approach should be slightly different now?
So in the equity markets, we have seen now eight consecutive calendar years of positive returns for investors since 2016 to 23. And this is unprecedented. In our though short history of capital markets, we've not had eight consecutive positive calendar year gains. So people are excited about investing in equities. A lot of people coming into trading, opening new demat accounts. A lot of people have moved to trading FNOs also. Now, wherever there was deep value or value stocks available, those have moved up significantly, especially in the last 2 years. So from here on, we need to change the approach a little bit. Market have reached their fair valuations. In some areas, we have moved to much higher than the reasonable valuations. So I believe we need to change approach a little bit. And I tell people that the only thing trading cheap right now is patience, and somehow nobody is buying it.
Well, that's correct. Nimesh, you have analyzed the relationship between small cap, mid cap versus large caps over long periods of time. Last 2-3 years have been very good for mid cap, small cap. One section of the market believes that this run may hit a rough patch now. Others say India is a stock specific market and the growth is pretty broad based. So why should small cap, mid cap as a space underperform? Uh, what does the data show?
So when we look at longer term, say 20 years kind of analysis of various parameters, first let me come to large caps. So large caps are trading at around fair valuation according to our internal metrics, where we look at not only earnings growth, but also say what assets these companies are holding, the return on capital of these companies, the sector mix in the Nifty. So we believe Nifty is at its fair value range right now. Historically, small caps and mid caps are high beta around this Nifty movement, and we've seen a significant run up in them. They are currently, at least the small caps are trading about 20 to 22% higher than what their 20-year averages have been. So we believe that's a space where you have to be a little cautious. Now, it is not that India is not doing well. India is doing fantastically well in terms of macroeconomic stability, earning stability, balance sheet growth. But even in a good economy, in a good business environment, it's not that market doesn't take corrections. So one has to be cognizant of that correction in a bull market comes like a thief in the night. So you have to be a little cautious when you are getting into areas which have already run up a lot, have moved up in valuations, expectations are high. Even a small change in these expectations can lead to a very sharp movement in stock prices. So people have to look at those areas which I would call as anti-bubble, that the crowd is not looking at because there are short-term issues. And there are many good companies in quality space where there are some short-term issues, but people are not looking at it. People want immediate returns. If the India decade story is good, people want a quarterly or a monthly return on that. That's not possible. It's better to look at quality companies right now, which are going through a temporary slowdown and can give you good long-term returns.
I think some of the consumer names, some of the QSR names, food companies can qualify that filter of yours because they've not done, SSG growth has been weak, volume growth is weak. But one thing I observed, they have not slowed down their expansion, many of them. But of course, nobody's talking about that area right now. Would you be eager to look for bargains there?
Absolutely. If you see some of the areas which are starkly undervalued or trading at low valuations compared to their historical averages, private banks is one large space there. What you mentioned within QSRs is another space there. A lot of consumer companies which are on a good structural uptrend but are going through temporary slowdown because last 2 years we've had a K-shaped recovery. Some of the bottom of the pyramid has not done well, or rural has not done as good as urban. So some of those companies, they are good long-term bets, but going through a temporary downturn or a slowdown in growth, and those are placed attractively, especially in a market where everybody is looking for a quick gain. People are looking at the next tick rather than the next quarterly or annual result, and that's why for long-term investors, this is an opportunity. Unfortunately, it's become a rare species these days.
That's true. Let's talk about private banks a little more. We were speaking to one big, large private banker recently, and he was saying that this tight liquidity scenario may actually peak out with elections. And when that happens, banks which have garnered liquidity or deposits, but not at very high rates, will emerge as winners, while the ones which are right now, garnering a lot of deposit at very high cost, will actually be on the losing side. Which section of banks do you like? Is it large private banks, large PSUs, or what exactly?
So today the expectations are low in the private banking space compared to the PSU banks. And yes, temporarily some of them may actually see some growth slowdown or some compression in the NIMs. But if you look at a slightly longer runway, these companies are trading at valuations which have very low expectations for the next 2 3 years. And if India is getting good liquidity coming, say, from the foreign investors from June onwards, when we get included in indices, a little better interest rate scenario globally, as liquidity flows start getting better, Fed cuts rates going forward. So those things will start making liquidity positive in the market. India is looking for higher capex growth and higher consumer growth. So these banks are intermediaries there, and they provide the kind of lifeblood to the economy. So I think these are the banks which will do well in the longer run. Temporarily, some slowdown or may see some pressure on NIMs. But that's where opportunity comes for investors to look at those areas.
Right, right. Nimesh, I want your thoughts on, something which is happening in the paint space. It's a area where players were few, prospects were good. More and more players started eyeing it, and now the view is that the industry will go from great to good. In this process, do you think valuations will get compressed of the existing players?
So whenever an industry sees an influx of new large players coming in, typically the incumbent sees some pressure because people expect market share loss or margins to be a little lower, and the valuation then compress to some extent. Once these players come in and the market shares can get reasonably redistributed to some extent, then people start pricing in the winners and the losers. And definitely in the paint industry, the same thing will happen. We'll have to see which companies actually lose market share and which companies are able to defend their premium and market share. So those companies ultimately will get higher valuations and will be steady compounders from there on.
All right, Nimesh, thanks very much for joining us on the show today.